Believe me when I say that YieldMax ETFs, the structure on how they create income and how they track capital value is different than anything else you're going to see. Technically, you could recreate the strategy yourself in your own portfolio. You're just not going to want to do it. To make sure we understand how these ETFs work and how they create income, let's dive into the prospectus for TSLY. Now, there's a brief breakdown here regarding the fund portfolio, where it talks about sold or short call option contracts, as well as purchased call option contracts. But what I really want to do is dive down in here into the synthetic exposure to the underlying security price returns. First thing you need to understand here is that none of the ETFs in the YieldMax portfolio, none of them actually hold shares of any of the stocks or ETFs they track. Instead, they hold call options to synthetically create long exposure. As it states here, the funds purchase call option contracts on the underlying securities, generally having 1 month to 6 month terms and strike prices equal to the then current price of the underlying securities at the time of the purchase, to provide the fund's indirect exposure to the upside price returns of the underlying securities. Since they are buying call option contracts, they pay a premium to the seller of the options contract to obtain the right to participate in the price returns of the underlying security beyond the strike price of the purchased call option contracts. Additionally, as it states here, they then sell put option contracts on its underlying security to help pay the premium of the purchased call option contracts on the underlying security. These contracts have 1 month to 6 month terms and strike prices equal to the current price of the underlying security. When you combine the purchased call options and the sold put options, then you get indirect investment exposure equal to approximately 100% of the applicable underlying security for the duration of the applicable options exposure. Now, I imagine that that was a little bit confusing for some of you, so let's look at an example. So let's look at Tesla here. Now, you could just purchase shares of Tesla right here, or what you could do instead to participate if the stock price goes up with Tesla is you can purchase options instead of just selling them. Let's come in here, let's take a look, let's try to replicate what YieldMax is doing with these ETFs. To model this, let's go out about 6 months to June. So we'll scroll down here. We'll look at the June 2025 contract here. And we're going to look at the current market price, 395. So we'll call that 390. Now, first thing we're going to do is we're going to purchase a call option. Call option's on the left. So we come over here. Let's just assume we're going to purchase one call option, okay, at 390. And that's going to cost us $6,885 to control 100 shares of Tesla for 6 months. Now, in addition to that, we're going to, and that creates the long exposure, by the way. So in addition to that, we'll sell to open. Okay, we bought to open the call option. Now we're going to sell to open one put option, same expiration, which is June 20th, and same strike price, 390. So up here, we're going to be paying $6,865. And down here, we're going to be receiving, because now we're an options seller, we're receiving $5,590. So the net on that is still a net debit. We still have to pay money, but to control 100 shares, it actually costs a lot less to do it this way. You pay about $1,275. Now, I want you to direct your attention to this section right down here. Notice that the break even is $402.75, or a price higher than the current market price. So we need for Tesla in this strategy, in this environment, to actually go up in value for us to break even. But in addition to that, you'll notice that the max gain is unlimited because we participate in all of the gains so far in Tesla by doing this, but our max loss is pretty significant too. It's the equivalent of losing all of our money. That's assuming that the price of Tesla goes to zero, which is unlikely to happen, but it is possible. In that scenario, our max loss is $40,275. So there's a ton of leverage here. We're paying $1,276, but the max risk here is $40,275, significant levels of risk. Now, this is not exactly what YieldMax does because there's one extra layer. Here, generating monthly income. Each fund also then sells call option contracts that are based on the value of its underlying security to generate income via option premiums. So instead of owning shares, they own call options, a combination of call options and sold put options to create that long exposure. And then above and beyond that, they then sell covered calls, not traditional covered calls that are covered by shares owned, but more of a synthetic covered call that still collects income, and it's somewhat covered because you are participating in the value increases if the markets go up. So to see this example right here, we would then add one more leg where we would then sell to open one covered call, and let's say we were looking at a weekly option here, like the 17th, let's say January 17th, and we would do it, I don't know, maybe at 420. So significantly farther above the current market price. If you factor this in, you had $12.75 in capital, and then you're collecting for this, 1 week, collecting $575, which is a significant yield. In fact, if you look at a traditional covered call yield, you would say, well, you need 100 shares, so that's $394.94 times 100. Means you have to invest about $40,000 here, and then you're collecting maybe, let's say, $575 a week. So we'll take $575 a week times, let's say you could do that every week. So times 52 would be about $30,000. Okay, quite a bit of income, but divided by $40,000. So it's a pretty significant yield at 75%. But look how significant the yield is if you do it through the synthetic exposure. So remember, we've got $575 per week times 52, $29,900 divided by $12.75. You've got a yield of 2,300%. So massive difference here, but you're still on the hook for the max loss just like you are with 100 shares. So that's where there's a lot of risk involved. So in a nutshell, this is what YieldMax does. They create a synthetic exposure to the underlying stocks or ETFs such as Tesla, ARKK, Nvidia, Coin, all of those. What they do is they sell put options and purchase call options to create a synthetic exposure. Then they also sell covered calls to create the income. And like I mentioned, as an average Joe investor, you could replicate this strategy yourself, but given the amount of risk involved, the amount of exposure to a max loss, probably not ideal for most investors. And by the way, this strategy I just talked about, it's the same for all of them. Whether it's Tesla, Apple, Nvidia, Amazon, Facebook, Google, it's all the same strategy. And you've got most of these ETFs actually are based on one underlying stock or ETF, whether it's, like I said, Meta or Netflix or Disney, but there's a few of them actually that are based on multiples or an ETF. So you've got OARK right here, that's based on ARKK, the ETF, which has underlying stocks that it holds. Then if you scroll down here, we've got the YieldMax or YMAX and YMAG, which is the universal fund of funds. So this is a fund that holds all of the ETFs in the portfolio. Then the Magnificent Seven holds those 7 underlying YieldMax ETFs in this portfolio. Oh, and then also we've got the ULTI right here, which is based on a number of different stocks that they write covered calls on in the portfolio. But most of them are based on an underlying single stock, which is quite a bit of risk.